Hello, I'm Juliette Sarli. In this week's edition of IG Macro Intelligence, we take a deep dive into the stocks associated with ex-tropical cyclone Alfred. Insurance stocks bounced back after the weekend as the Insurance Council of Australia declared ex-tropical cyclone Alfred a catastrophe. The Insurance Council indicated many more thousands of claims are expected from the weather event, citing, though, it's too early to assess the overall cost of the devastation. Meanwhile, shares in the insurance repairer Johns Lyng slumped amid confirmation it would be removed from the ASX 200 during the upcoming quarterly rebalancing after shedding a quarter of its value over the past 6 months. Well, analysts are broadly positive on all three listed insurance stocks, QBE, Suncorp and IAG. QBE shares have risen more than 20% over the past 12 months, with ASX TradeWatch data showing they are in a strong bullish trend. The average broker recommendation on the stock is a buy, with a target price just under $23, suggesting that it can add a further 9% from current levels. As a broader general insurer, QBE's direct exposure to Alfred and the follow-on effects are expected to be less significant than those facing IAG and Suncorp, a reason why John Lockton from Sandstone Insights prefers the stock.
QBE, we think, is the preferred out of those three. It's got more of a runway to lift earnings out of the US and capital management, something we haven't spoken about with QBE for many, many years. I suspect as we go through 25, they're in a position to do capital management, probably buyback.
However, Ord Minnett retains a hold recommendation on QBE owing to what it calls greater exposure to international premium rates and wider macroeconomic risks. CFO Inder Singh told Ausbiz recently the insurer, which operates in more than 25 countries, is well diversified, allowing it a strong buffer against isolated weather events.
We operate in a number of the major markets in the world. You know, the US market used to be a real Achilles heel for the company. We're very proud of the turnaround in the US business. You know, we're starting to see some really interesting growth opportunities emerge in that region. Our businesses in Lloyd's and our businesses in the UK regional market are some of the leading businesses in those markets. So we're incredibly happy with the performance of those. So, you know, I think the wonderful diversification by product, by region is a real distinguishing feature for QBE and one that gives us a lot of confidence, particularly around the growth outlook going forward.
While Suncorp shares are up only around 5% over the past 12 months, with technical analysis showing they're in a downward trend across both the short and longer term. That is an indication market participants see better value elsewhere. Suncorp announced to the market it has implemented an additional comprehensive reinsurance program to protect against significant weather events, with a maximum event retention of $350 million and primary catastrophe coverage of up to $6.75 billion, including full reinstatement. In the first half of 2025, the insurer was $277 million below its natural hazard allowance for the period. The average price target, however, on the stock is a buy, according to Refinitiv, with a price target of $24.65, suggesting it can rally by almost a third. Ord Minnett has an accumulate recommendation on Suncorp, while Morgan Stanley is overweight the stock with a $22.10 price target. Ord Minnett also has an accumulate on IAG, which updated the market that it has perils cover of $680 million, which the broker says provides strong downside protection against retained natural perils costs exceeding its full year 25 allowance of $1.28 billion. Shares have risen almost 26% over the past year. Again, the average broker recommendation on Refinitiv is a buy with a price target of $8.56, suggesting IAG can rise a further 10% from current levels. But ASX TradeWatch data show that the 5-day moving average is beneath the 50-day moving average, suggesting investors also see better opportunities elsewhere.
But start trimming, manage your expectations. If it starts to roll over further, keep taking more money off the table. I think the insurance sector, it was a great deal a couple of years ago. It's had a huge run. So, you know, enjoy the ride. These things, everything is a cycle. When the music stops, you don't need to be there.
Well, Johns Lyng Group is an integrated building services provider. It provides restoration services across Australia and the US, and its valuation lies in its ability to rebuild and restore properties and contents after damage by insurable events, including weather events like Alfred. Shares, though, have slumped almost 70% over the past 12 months and are down 36% since the start of the year, forcing the ASX to push Johns Lyng Group out of the top 200 at the next quarterly rebalancing, replacing it with Life 360. ASX technical analysis seems to show shares are following a long-term bearish trend, suggesting weak demand for the stock. Macquarie recently cut its price target on the stock by 47%, and Citi lowered its target to $2.70 from $3.95. But the average recommendation on the stock is a buy, with a price target of $3.41, suggesting it can rally a further 40% from these lows. And on a recent episode of AusBiz's The Call, guests labelled Johns Lyng Group a double buy.
The second half of their business is the catastrophes, floods, fires, cyclones, that sort of thing. And in the half year, there wasn't much of that. So their business in that sector shrunk quite dramatically from the previous corresponding period. The market hammered them for the fact that they didn't do quite as well as guidance. But their guidance for the full year is above what they did the previous full year, but not as much above as I think people had been expecting. But I must say, I thought the massive drop in share price was quite absurd.
And that is your IG macro intelligence for this week. We'll see you next week.